What's up, man?
Hey, I am rested, feel good. You've been at JP Morgan, traveling around, doing everything. Excited to have you back.
Thanks, man. I actually got pretty good sleep while I was there, so I'm reasonably rested given how many meetings Catherine and I took while we were out there. The weather was better than it's been in the past, and also I gotta say, man, those rumors about Newsom cleaning up the city.
Yeah, you said San Francisco is nice or nicer.
Feels to me like they power washed the streets and rounded up a bunch of people. I know that that's not the kindest thing to say, man, but I haven't experienced San Francisco in that way, like maybe ever, because I didn't start going until all of that had already, in the 14s, 15s. I mean, it was already kind of moving in that direction from the Tenderloin perspective.
So you didn't see homeless people on the street all over the place?
No. It wasn't until I was at Catherine and I were at an event at the press club, and then we sort of spilled out onto Mission, and there was sort of the first time that I actually ran into a few people. But for the entire rest of the time, and I did a lot of walking around town. Like I wasn't all Uber to Uber. I did enough walking that I was like, this is. Somebody did something. Yeah. Okay. Somebody did something, and I'm not sure it was done.
Well, however it was done, it's great to have the city be on the road to recovery. Maybe.
I think the question is whether or not it's temporary or it's you know what I mean? Like, are we going to go back in 2 months and then it's sort of all just back and it was really just for show?
Did they do it just for this 1 week period for JPM?
Right.
Yeah.
Right. My wife Rachel would always tell me about when she was an exchange student in China for a little bit. Yeah. How in certain cities there would be times when China would have international dignitaries in and they would shut down all the smokestacks so you could see the sky. You know what I mean? Right. But it was a show
for that 3-day period.
Right. It was a show. So anyway, cleanest I've seen the city in a long time. Weather was pretty good. Shout out to Holland and Knight, our law firm. Yeah. They were incredible hosts to Catherine and I. We got to have back-to-back meetings in their fantastic office. I'm really happy with this law firm right now. Yeah. And we met all sorts of great people, Nancy Ann DeParle at Consonance Capital. She hosted a breakfast and invited me and, made a bunch of wonderful connections. The Aspen Institute's Health Innovators Fellowship had a couple of different events that were awesome. It was a good time. It was a good time.
It always kind of sets the tone for the year. Like you meet face to face with a ton of people. I mean, Nancy Ann, but even people that you know fairly well, like catching up and getting ready for the year, it creates a ton of work, but it gets everything lined up for the first quarter.
Yeah, really. Exactly. And look, were there a bunch of announcements? Yes. But as we're about to roll out on our show, I mean, the transactions were just not who cared? It was less about transactions and more about transformation, right? If somebody had a transformative story, that was a big deal. A lot of people were talking about the Lilly Direct announcement from the week before. Right. So I actually think that was really smart that they announced that before JPM.
Yeah, so then it was the top, the cocktail party chat.
Exactly. Yeah. It gave everybody something to talk about because you're too busy to read the news. Yeah. Right. So that was a big story. And then there was a fair amount of conversation around things that are happening in AI and obviously on the capital markets. And we're definitely going to dig into both of those things.
Yeah.
Are you ready?
Yeah, I'm ready.
All right, let's do it. All right, let's start with CPI.
Yeah, so today, the December CPI came out slightly higher than expected. I think people were largely looking for a 3.7, ended up at 3.9. And I think that we're just going to have this kind of bumpy process where inflation is in general coming down, but not every month coming down.
Right.
And if I'm glass half full, this is what a soft landing looks like. It's not without some work left to do. But the reason so for people that are listening, we go back all the way until 1960 just to give perspective. But I think the reason I pulled that is that the last 20, 25 years, we've been really blessed with very low inflation for so long that a lot of people working have never been in an environment with high inflation.
Yeah. I mean, I was born in the high inflation window,
Right.
so
Right.
I know nothing about it, right?
Yeah. Yeah, exactly. I mean, I got out of school in 93, and that's right when the what's called the Great Moderation just started. We're like, it hasn't been high inflation since then, really.
Right.
But the fear of central bankers is from the 70s, where people that are listening maybe can't see this, but we had a huge spike in inflation, and the Fed fought against it. But then they sort of got comfortable that it was on the decline and getting better. And then there was another huge, big spike. And so I think Chairman Powell and every Fed chairman since then have been very nervous about letting off the pressure too soon.
Yeah, over the course of the 70s, and this is like the iconic time that everyone talks about, the Volcker era and all that kind of stuff. It got to 11.7%, and then they got it down to around 6%, and then it shot back up to 13.6%. So I think that's what you're talking about, sort of this rebound, that it was even worse than sort of the previous high.
Yeah, exactly.
Is the concern, and exactly why there's so much caution from the FOMC.
Yeah, and in the threes is much better than we had 2 years ago.
Right.
But it's not at the Fed target of 2.
Right.
And so the question is, how long are they going to keep rates high? The stock market sold off today on this news. I think people were hoping for it to be in line or maybe even a little bit better than planned. And it just means they're going to probably have to keep rates higher for longer than we would like.
Yep. It does seem that way. So, with that December print, not really expecting any rate cut over the next sort of 30 days at least, and hopefully we'll see some better news in February of the January print.
Yes.
Okay, so the next story we want to talk about, this Carta story, because when I first saw it, I saw the original post on LinkedIn and Twitter from Carrie Sarinen, and I could be mispronouncing his name, the CEO of a VC-backed company called Linear. I found the post, and I shared it with you on Slack, and I just said, hey, we just need to track this. Full disclosure, we are Carta customers. And so, I said, listen, I don't want to talk about this on the show yet, but let's just track this whole thing. And the story is that Carrie was disclosing via a screenshot of an email that one of his investors received, soliciting that investor to potentially sell their ownership in Linear on Carta's secondary market. Now, there's a lot wrong with this, but I know that some of our listeners don't necessarily understand what's exactly wrong with it. So I think we should take a second to just kind of break this down a little bit. So
So let's frame it up just in the general market environment first. So Linear is a venture-backed private company,
privately held company. Yeah, very important.
And it is a very strong team. Great, they're doing well. They're not in healthcare, so I don't cover it that closely, but it's a good team and a well-known growth company. There is a very active secondary market for private shares. A lot of investors are trying to buy positions in companies like Linear that are already doing well, and a lot of the risk has come out, and they're willing to pay up for these as opposed to waiting until they go public or whatever, because it's taking longer and longer to go public.
Right.
And Carta, along with several other groups, are trying to make that process more efficient.
Yeah, but so Carta, different from many other companies, is the software system of record for something like half of the venture markets today, right? So they actually have the critical mass to create a true liquidity market leveraging secondary shares.
Yes.
Just because of the volume, the critical mass of companies that manage their cap tables, manage their securities, and manage their investor relationships on Carta.
Yeah. And so 2 things. Creating a marketplace where sellers of secondary positions and buyers can find each other more easily and transact more often, or there's more There's more transactions that are potentially there. That's a good thing.
That's a great thing.
And I think Carta is in a good position to build this. But it needs to be I think it needs to be an opt-in, like intentionally decide that either the company or the shareholders or like people opt into it. And that was the thing that really was shocking and is, I think, not acceptable.
It's definitely not acceptable, and everyone who's an active player in the private markets knows that this is not acceptable.
Right.
And what I loved about the post that Carey put together was he explained exactly why it's not acceptable.
Yeah.
In a privately held company, who has your shares is really important. Generally speaking, they're not just a financial player. They are often a strategic player. They're there for very important reasons. And people who have shares in your privately held company can either be really helpful or they can create a lot of problems for you. And so you want to be careful about who is on your cap table, who has ownership in your company. And you want to be very thoughtful about who you offer secondaries to. That's the other thing, right? It's not just, do I want to offer shares of my company on the secondary market? It's also, who do I want to offer them to? Many times you need a board action to do this. Many times, the management team can't just decide we're going to do this. They actually have to get board approval to offer secondary shares. So anyway, I just wanted to kind of really emphasize that.
I think the facts are that Carta reached out a cold email to one of the shareholders, could be more than one, of Linear, trying to see if they would sell their position for X price.
Mm-hmm.
And Linear has not opted into this. Obviously, it's concerning that Carta controls. I mean, we custody our stuff there.
That's right.
A lot of people custody there, and it's not ethical or legal, I don't think, to do that without permission. Carta has since come out and said it was in error, and whether it was a one-time mistake or something that was a rogue salesperson or an actual program, we don't think we know. But it's very clear that there's not enough separation. It shouldn't be possible to have a mistake like that made. And so it's a, I mean, as the article says, it's a big credibility issue.
That's right. So I think what has been really interesting for me is to watch from the genesis of a couple of social media posts that I happened to see and share with you how fast this thing blew up. Carta's CEO, I think his name is Henry Ward, he's been a little bit embattled and a lot of it on social media for a variety of different things. It's often been around sort of employee dissatisfaction. I think the majority of the stories have been really around employee dissatisfaction. So he actually engaged with the CEO of Linear on this matter, and that just sort of spun it up into a legitimate news story. And you started having all sorts of, I mean, it probably got referenced on All In. I definitely saw Chamath, tweeting about it.
Yeah.
And it's at this point now where this company that had this aspirational business model, right, to be a critical mass platform for the private markets so that it could eventually create a liquidity market, which is something we've never had. We've never had a liquidity market, an efficient liquidity market in the private markets, right? We've never had that. I think their principal valuation was based on them eventually getting there. They have an almost $8 billion valuation.
Yes, the custody alone is not
it's not enough. Right. It's not enough. And apparently they are shutting down their efforts to do a secondary market as a result of this. And so there's a lot of potential downstream ramifications for this. We don't know. Carta itself is privately held, right? They're not publicly traded. Okay. So we actually don't know if they're making money or burning money. We actually don't know if they are going to need to raise more and more money to keep operations going, but they have half the private markets on their platform.
Yeah. We want them to be successful.
Please, at this point. But this is actually like a potential, it's not quite the same thing as an SVB, but it has some really ugly potential outcomes here if this does not get resolved correctly.
Yeah, and I think they're shutting it down, but they're aspirationally, they want to do this eventually. And I'm not opposed to Carta doing it, but it has to have a wall between it. It can't be sort of easily sort of falling into the day-to-day custody work.
Yeah, and you just cannot cold outreach to somebody's investors on their cap table asking them if they want to sell their shares.
You can't unless they opt in and say, like, what happens is employee options typically are where a company decides, well, we've been private for 10 years.
Sure.
We have all these people, some of which have left now, and they're looking for liquidity, and we need to sort of facilitate that.
Yep.
And we don't need cash to grow.
Right.
So we're not raising money internally. So they could then allow that to be like an opt-in. And I'm not opposed to a group doing both functions, but you have to separate the two. Can't be commingled.
And even in those cases, many, not all, but many of those options have a buyback right of the company where they get to buy it first before you get to sell it outside of the company. So that's what I mean. Like there's just no world where this behavior was even remotely allowable.
It wasn't allowable, and it wasn't going to work.
No, it's so crazy that they let this happen, right? I mean, so we'll see.
We'll see how it evolves.
Yeah, I mean, we'll see how this evolves. But
you're right. The story, and it's just the world we live in. Stories can get they're on social media first.
Yep.
And then they quickly escalate, and then it's in the media.
Yeah. And this one social media post, which was justified, quite frankly.
Yeah.
You know, I mean, I feel like the CEO of Linear effectively did a PSA because he knows how many people are on this platform and said, hey, listen, you might want to know that this happened to me, right? So there was kind of fair play, PSA. And now, like, this platform literally this week may have a lower valuation. I mean,
they definitely have a lower valuation.
You know, like right off the bat, like off of one social media post from one really stupid thing that happened inside of the company. So I think it's a cautionary tale, but also something we're going to have to watch as venture platform that's on Carta.
Yeah. Yes, that's right.
All right. So moving into JPM stories, as we said, we don't really want to talk about.
Yeah, I mean, there were several hundred stories.
Yeah.
But
and most of them transactions.
Yeah,
this acquisition, that acquisition.
Right. We're trying to talk about strategic things that kind of fit into where we see kind of the healthcare and the healthcare innovation market going.
Yeah. Actually, can I just give a little commentary that's not here? One thing that was discussed around a lot of the people who I met with was just how heavy, and it had always been this way in the past, but just how sort of dominant biotech and pharma was at this year's JPM relative to healthcare services and especially digital health. Startup Health took a break this year, so they didn't have their Startup Health Festival, which was really sort of the convening around all the digital health activations. And in the absence of that, nobody came in and filled that gap. And so it was really a light year to talk about all things digital health, which is kind of weird given where we're going with AI, right? I mean, I think it was a pretty big missed opportunity. You only had like big companies talking about it. There was no sort of showcase of all, and it was in San Francisco. I mean, you can imagine what a critical mass of AI companies have been funded in San Francisco to take on healthcare, and we really didn't get to hear about them or see about them in any meaningful way. So that felt like a big miss for the conference this year.
JP Morgan, they're a bank, right? So they are trying to kind of convene the industry in order to get banking business done.
Yeah, their middle market starts at 20 million, just so everyone understands.
Right. Yeah, and where the most deals are now is biotech pharma.
Yeah,
I mean, there's a lot of announcements that happened. I couldn't keep track of it, but there's several acquisitions.
Yep.
And so as far as a fee perspective, that's where it is.
That's right.
I was talking to someone that because I didn't go this year, and this other woman I was chatting with decided not to go either.
Okay, and
it's less of a really big news, strategically valuable news than it used to be, and much more of like a go to find a deal or go to meet some deals. And I had two portfolio companies, in active sort of exit processes that were out there, and it was great for them. You have lots of people looking to find opportunities. But as far as like the breaking news or like a real interview that you would have like at the conferences we used to do, or another conference that's not sort of focused on banking, they don't have any like actual deep interviews. It's much more like PR. Let's announce what we have going on.
Right. Okay, so let's get to the stories we actually found interesting. And this is a subset. There were others, but like here are 4 stories we actually found interesting. So the first one was Jefferson Health partnering with the Lehigh Valley Health System and really sort of focusing on their insurance business, really focusing on doubling down on being a payvider, acknowledging that the fee-for-service model is not only waning, but also a highly fragile model. You go into a time like a pandemic and fee-for-service just kills you, right? And so you need something to sort of balance that and make you more anti-fragile. So I think the reason why we want to talk about this is because it's in line with our broader theme around the defragmentation and around the future of this industry really being in that vertical payvider stack.
Yeah, and we've seen a lot. I mean, I can't tell you the number. Several health insurers moving into providing care. Of course, Lilly started going direct to consumers last week. So we talked about this is the first decent sized health system that is doing an acquisition, and it's the intent is to grow their payer base, grow the lives under coverage.
Yep.
And that's great to see. I mean, we need to have health systems, understand this is the sort of game plan. This is the strategy that's going to work. Having delivery care and the insurance business integrated together. And Jefferson's a great platform to sort of lead the way there.
Yeah, and they're in a very competitive market too, right?
Yeah.
That Philly market is super competitive. So seeing them, sort of make this move, I would imagine we're going to see others in that market making similar moves. So that's really cool.
Yeah.
Next story we wanted to talk about. You found this one really interesting. I agree. My background's in digital marketing. WPP, which is one of the I think 3 big mega agencies.
I mean, it's a global agencies, big advertising marketing agency.
Yeah,
and they announced today healthcare marketing. In 2024, like the new way to do it, and they're really focused on oncology and cancer marketing. And kind of changing the narrative around what it means to get cancer and be under oncology care. And WPP is badass. I mean, like they are really good. And they have not ignored healthcare, but they haven't really been focused on healthcare.
Yeah, they have it in their family of agencies. I think Ogilvy Health is probably the big name in the healthcare space. They've got VML Health. Ogilvy is the one that I always sort of think about.
Yeah. So for them to come out today with this idea that sort of the new approach to marketing using AI and narratives and really consumer focus, which WPP is really good at that. I think that's something to watch because our industry hasn't been brand consumer marketing focused, and I think if a few platforms started doing that and hired WPP to do it, you could maybe pull in a lot of patients from around the country into your region.
And look, here's another thing, right? I met up at JP Morgan with a new fund manager, a guy named Ben, who's launching oncology ventures. He's a cancer survivor himself, and really everything he's focused on is not so much drug discovery, but more patient experience. And as someone who lived with that, I mean, and
it's a terrible experience.
It's a terrible experience, and quite frankly, if you understand like how anxiety sort of can impact your immune system, how you communicate about this stuff actually can have an impact in the outcome.
Yes.
Right?
I think it definitely does.
Yeah. There's real opportunities for upside here. There, in care delivery, in the patient experience. I was having coffee with my buddy Clint this morning and talking to him about a family member's experience with cancer, and that it was caught at what we've been told is a very early stage. But the way that it's described, okay, is smoldering. And I understand that's probably a technically accurate term.
Right.
But like, how does smoldering sound to you? Does that sound early, or does that sound like awful?
It sounds like it's going to hurt me and be really bad. I don't want anything smoldering.
Right. So like, while they're sharing this with us, and this is no shade to the doctor, they're just doing what is the protocol. Yeah. They're communicating that this is a good scenario because it was caught so early, and it's before it really starts being aggressive, and it's in the smoldering phase, and it's just like, that's just not how we communicate as humans, as civilians, right? Like, how can we start to translate some of this technical stuff?
If it's in your body and it's smoldering, you are immediately scared and not able to listen to everything else that's being said.
That's right. And I actually think this is just smart business, because we are at a point where cancer diagnoses are, it's hitting like 1 in 3. That makes it a mass market issue. Like, if you just think about a WPP and they're looking at, marketing, 1 in 3 people, that's a mass market issue.
100 million people in the U.S.
Right. That's a mass market issue. And, it's a high margin part of the healthcare business. It's one of the few truly still profitable spaces to deliver care. So that means there's margin to do things like message better, package better, communicate better, engage better. So this is,
and the spectrum of treatment availability varies dramatically.
Yes.
Based on where you go get care. So the opportunity to create a marketing story, and they talk about narrative, which is brilliant. Narrative around, come to our facility and we have better options. We have clinical trials. We have all these choices for you. You still might be able to have everything taken care of with the vanilla option, but don't you want to be in a place that has all these choices, and you could pull in a lot of patients that are willing to travel to get better care?
Yeah, so this is exciting. They're also talking about how they're going to engage AI in their marketing actions, and that's a good segue into the next 2 stories, which are both AI stories. So Mayo Clinic talks about partnering with a startup, Cerebrus, on building out their own foundational model. Vic, when I did the summer retreat for HFMA with the board of directors in 2023, the current board chair is Dennis Dolan. He's the CFO over all of Mayo Clinic. And he gave us all just a wonderful tour of the entire, campus. And
up in Minnesota, yeah.
And listen, if there's any health system that I think has the ability to leverage AI to actually improve care, it's Mayo. I mean, these folks are unbelievable in what they do. And what I just loved about it is that they're partnering with a startup.
Yeah.
Like, that's obviously just great news for us, for the innovation industry.
Yeah, and I think I agree with you. I trust Mayo to kind of leverage AI, but also understand sort of the safety and the efficacy and do it in the right way. I think it's great to see them come out and kind of lean into this.
Yeah, they have the platform, they have the campus, they have the, quite frankly, a very high quality faculty there.
Yeah.
They have a med school there. On campus. They have a partnership with a nursing school that's in the area, and a lot of resources. A ton of resources. So this is great. I mean, this is not just buying a model. This is building a model. Just so we're really clear, they're talking about training a model. That's not the same as tuning a model, which is what we are all doing, with ChatGPT, where we're just kind of talking to it. They're literally training it with their own first-party data that they have generated. And remember, Mayo isn't just a caregiving facility and a teaching facility. It's also a research facility. So they have tremendous amounts of data that they can use to feed into a new model.
Yeah, and I think the way I think the trajectory is going is the big LLMs are kind of commoditizing. There's a lot of great capabilities, but the open source models are catching up to the proprietary models.
Totally.
The only way to differentiate is to put different data into it, and Mayo has a lot of really valuable data, and I trust them to sort of use it in a way that's going to be great for healthcare.
Yeah, and look, as we've said, ownership of the data is going to be key. I don't know if you saw this week, but there's rumors that OpenAI is in licensing agreements with different news
Yeah.
organizations because
They
lo and behold, you're going to have a
Yes.
license for this data. I'm telling you, like, you're not going to be able to just take all the data and scrub it that you want. So
they
data
fought
ownership's
back
gonna be
pretty
big.
hard against the New York Times.
Yeah,
But they also are licensing with a bunch of other media companies.
Right.
So it's like both ends.
Right. So, I mean, they're fighting with the New York Times because the New York Times punched them in the face.
Right.
But they're simultaneously trying to avoid potential follow-on suits by engaging in licensing, agreements, right? Which I think to a degree just kind of proves the New York Times point, right? I mean,
yeah, I mean, there's different points. I think that every media company is gonna protect their data so it can't be used in the future. They're going to put it behind paywalls, even if it's a very cheap paywall, so that you can't just sort of be sucked into training data.
Good for them. It's their outputs. They literally are paying for this. Like, you know what I mean? It's not community data. All right. Next story on the AI front is Option Care Health. This is the large. I think they're still privately held.
Yeah, I think so.
Right. I think they're still privately held, but they are a national leader in infusion care.
Yes.
Quick shout out to my buddy Norman Wright, who was just announced a board member of Option Care Health.
Okay.
Yep. And they're kind of on the other side of the spectrum. Mayo is partnering with a startup. Option Care Health is partnering with Palantir.
Right. Probably the largest big data company and one of the oldest.
One of the oldest, exactly. And they're doing that for nurse scheduling and supply chain, which is very, very smart. But as we dug into this article, we found out that Palantir is not starting with Option Care Health. They've had deals with HCA and LifePoint. So they've already been in the healthcare space partnering with some of the, larger companies in the caregiving side of the business.
Yeah. Yeah. And they've been doing this for a long time and a lot of big brains over at Palantir.
Yep.
But I think it's interesting that Option Care, we covered it here. They tried to acquire Medicis and merge with the Medicis. That deal fell apart, and United ended up getting that deal.
Yep.
And so now, instead of that, like, go big and sort of go across the whole country, it seems like now they're maybe trying to get smarter and have a much more differentiated solution, which seems like a interesting strategy.
Yep, for sure. All right. Well, look, that's our JPM wrap up. Like I said, if you wanted to see sort of all the other deal stories, you can just check Modern Healthcare or Fierce Healthcare.
Of sources for that. I think we're trying to bring a different perspective around the innovation and how the landscape's changing.
Exactly. And we're going to take a break, let Doug share a little bit about Jumpstart Foundry. And when we get back, we're going to come back to covering a story that we covered, I don't know, maybe in episode 12 or 13, talking about the Chevron deference.
Thanks, guys, for the opportunity to talk about our pre-seed fund, Jumpstart Foundry. My name is Doug Edwards, CEO of Jumpstart Health Investors, the parent company of Jumpstart Foundry. We're so excited to be able to talk about early stage venture investing, certainly the need for us to change the crazy world of healthcare in the United States. We are spending 20% of our GDP, north of $4 trillion a year on healthcare with suboptimal outcomes. Jumpstart Foundry exists to help us find and identify and invest in innovative companies that are going to make a difference in healthcare in our country. Every year, Jumpstart Foundry invests a fund, raises a fund, and deploys that across 30, 40, 50 assets every year, allowing ease of access for our limited partners to invest to help us make something better in healthcare. Some of the benefits of Jumpstart Foundry is there's no management fees. We deploy all the capital that's raised every year in the fund. We find the best and brightest, typically around single-digit percentage of companies that apply for funding from Jumpstart, and we invest in the most incredible, robust, innovative solutions and founders in the United States. Over the last 9 years, Jumpstart Foundry has invested in nearly 200 early-stage, pre-seed stage companies in the country. Through those most innovative solutions that Jumpstart Foundry invests in, we also provide great returns and a great experience for our limited partners. We partner with AngelList to administer the fund, making that ease of access not only with low minimums, but the ease of investing in venture much better. We all know that healthcare is broken. Everyone deserves better. Come alongside us with Jumpstart Foundry, invest in making the future of healthcare better, and make something better in healthcare. Thank you, guys. Now back to the show.
All right. So Vic, you found this entire thread of things, and I think there's a series of stories that span beyond healthcare, but obviously this is a big story for healthcare because of the huge role that the regulatory agencies play in healthcare. But Eugene Scalia, who was the Secretary of Labor under President Trump, and also happens to be the son of not Chief Justice, but Justice Antonin Scalia, wrote an opinion in the Wall Street Journal that feels like a spoiler on where the Supreme Court is headed with regards to the Chevron deference. We'll probably talk to Emily about this next week, but why don't you just like frame up a little bit about the Chevron deference for those who didn't listen to our previous episode?
So Chevron is a case from the 60s or 70s, a long time ago, where the Supreme Court previously decided that they would give deference to administrators like the CMS, for instance, that in general, if it's unclear what the law is, that the executive department or the bureaucracy that is in charge of managing this part of the government should have deference and get to use their best judgment to make decisions on behalf of their constituents.
Yep.
And so if it's very clear that they're going against the law, then of course the courts would step in. But in general, if it's not clear, there's like this, default position that we're going to let the bureaucracy make decisions because that's the best place to do that.
Right.
And there's a court case up in the Supreme Court right now, which is why we're all talking about this, challenging that. And a lot of people, including me, think it's going to get overturned, where it's no longer going to be that default position. And in healthcare, there's so much that is managed by HHS, CMS, all the regulatory bodies. There's going to be a lot of things that are now subject to be called into question.
That's right. Yeah. And I think what's been interesting is to see that there has been, I think, less willingness from the players in the private and even public markets to just stand back and take whatever the agencies sort of say and dictate. I mean, it is in fact true. And by the way, this was episode 2 of Health Further, so that we literally started this podcast talking about this. It is true that, look, these agencies are all effectively staffed by whichever party is in power in the White House, okay? And the way that they run them is, they have a series of commissioners, and there's always a chair of the commission, and it's always a majority allocated to the party that is currently in the White House, with a majority there for the purpose of dissenting, and at least representing a dissenting view. But really, they can, they can argue and try to persuade their commissioner colleagues. But generally speaking, we've seen just a ton of voting across party lines, and the agencies have become these tools to effectively push through policies from the executive office. And this has happened on both sides of the aisle. It's not a Democrat or Republican thing. This is how the executive offices have decided they're going to get things done in line with their promises to their constituents, especially when Congress is kind of, broken, where there's constantly
that's the thing, is that we're not in a position where Congress can actually pass meaningful laws.
Right.
They can't even pass a budget. And so we end up with this executive order dynamic where the president just says, like, we're going to go this direction. We've covered, 10 or 15 from the Biden administration over the last few months.
Yep.
And that, I think, is going to change if this gets overturned.
Yeah. So we just want to talk about 3 different stories here, with 3 different agencies that are all currently kind of going on, just to kind of frame up how, in a world where Chevron deference is no longer the law of the land, the outcomes could be very, very different, right? Yeah. So the first one is related to Medicare Advantage. So we had a whole episode again with Emily breaking down the huge changes that are afoot with Medicare Advantage.
Yeah, the star rating got totally
It immediately sort of put a whole bunch of health plans into inviolable status, right? They moved from 4.5 stars to sub 3.5 stars,
Right.
and basically you're losing money at that point. So it was announced on January 5th that Elevance Health is suing CMS for changes that were made to the star ratings methodology.
Yeah, and whether you think the new star rating is good or evil, I happen to think it is pretty, on general, good. The ability to question this and sort of have a lawsuit that then we're going to be in a position where no one knows what the outcome is, especially if the Chevron doctrine is sort of overturned.
Right.
Where now we're going to be in the courts and really no decisions can be made very quickly. But I think it's right that Elevance is questioning this because it's not legislative. It wasn't sort of enacted by Congress.
Yeah, and I think, I mean, look, people have their sort of pejorative views of different healthcare companies. Some people don't like pharma. Some people think the payers make too much money. Like, regardless of what you think, just listen to this. Elevance Health said on their last earnings call that they're preparing for a $500 million hit to bonus payments. So imagine you start the year sort of projecting a certain thing, and then by the end of the year, you're all of a sudden expected to take a $500 million haircut. I mean, there's clearly something in that process of changing the ratings from a rollout perspective that can be something that organizations can actually absorb. Most organizations cannot absorb a surprise $500 million haircut. Yeah.
Well, and I like the way the star rate, we talked with them, I like the way they're trying to shift it to, better alignment with outcomes and with patient care.
For sure.
But it was dramatic and much faster than anyone expected.
Yeah. So it feels like here we're really talking about a rate of change issue, not so much like the direction of the evolution of the methodology.
And it's really dysfunction at all levels. Like, if Congress was more functional and there was more clarity of sort of what's going to happen and it was actually enacted in law, then you wouldn't have all these issues.
That's right.
If it gets overturned, I fear we're going to have just more uncertainty, more unknowns, more people correctly being able to sue and try to stop things.
Well, here's the deal. If, in fact, the Chevron deference does get overturned, that does not fix Congress.
Right.
Okay.
That's the problem.
And what that then I think is largely going to do is it's going to create more needs for things like ARPA-H, for example, which are things that are totally outside of the agencies. And it's just like the executive office grabbing a bunch of budget and just doing things kind of off the book, right? So I think that's kind of one model that you could see. And it's also going to force the industry to drive better results through innovation. I mean, because you're not going to have as many levers that are going to be changed and pulled kind of year to year. So interestingly, I think the big changes that were made in this last physician fee schedule that were rolled out in November, and these big Medicare Advantage updates, and also the price transparency rules, and also the drug negotiations. I mean, it could be that the White House knew that the Chevron deference thing was on the horizon, and they just were like, we're just pushing all this stuff through now because we may be hamstrung, by the end of 2024 to do anything about it. I mean, it's...
Yeah. I don't know. We'll talk to Emily about it. I think she's on next week, maybe. We'll talk to her because I'm worried that there's going to be just a huge rash of new court cases now.
No
and you're not
question.
going to have any clarity, even worse than today, of like what to do.
Right. And then the FDA issued mass approval of drug imports to the states from Canada.
Yeah, this is ridiculous and a sign of complete incompetency. I mean, the idea that we are going, as a country, are going to allow and encourage the import of drugs that are under price controls in Canada for the benefit of Canadians, because we can't get our act together to decide how we should price our own drugs, does not make sense in any world. But they have allowed it. So now you can, at least I think Florida was the first place, you can like the state of Florida for their Medicaid book is buying drugs from Canada.
That's right.
That does not make sense to me.
I mean, listen, it makes sense insofar as I don't want to hear that people cannot get access to basic drugs that they should have access to, right? So, like,
yeah, I agree with that.
I start with an orientation towards the patient,
yes,
the patient's needs, and we can talk about the logical path of the solutions that we've chosen and whether or not they make any sense at all, or whether or not they demonstrate that like our own supply chain is totally dysfunctional. Ultimately, we got to be able to get the right drugs to the right patients. Okay, so that's where I start. But I don't disagree with you. Like the fact that this is where we are is ridiculous.
I mean, the U.S., I don't have it. I should have looked it up. I think we probably buy 50x as many drugs as Canada. And we're going to take their pricing just because we can't get our act together to do it ourselves. I think the answer is yes. That's what we're doing.
That's the answer.
The interesting thing is that both, so Biden and Trump and DeSantis are all in favor of this.
Yeah.
And so like, I don't think there's any other topic that I can think of that they're all in favor of. So it's crazy.
Yeah. All right. And then
but that's an example where people are, questioning how it should work.
Yeah.
And the FDA just made a decision.
Yeah, that's right. And then the final story is not a healthcare story. It's Bitcoin.
Yeah.
So after 10 years of just totally stalling on any form of reasonable progress, and really, I would say, an all-out assault in what's been called Operation Choke Point 2.0, led by Gary Gensler and the SEC as of last year, over the last 2 years, the Bitcoin ETF is finally live. And in the first day of trading, almost $5 billion of volume.
Yeah, that was today.
That was today.
Yeah.
Day one. And this is another space where, it's hard to look at. It's really, really hard to look at the way that the SEC has managed cryptocurrencies and effectively not given any clear guidance to the market as to whether or not it is a security or it's not a security, has levied really aggressive penalties on companies in America and effectively has offshored the industry, especially when it comes to exchanges. So, there are no on-ramps. It's not safe for banks to be partners in the crypto industry. It's been sort of characterized, I would say, largely by the Democrats in Congress as sort of a tool for terrorism. Never mind.
No facts related to that.
Never mind that like most of the money does not go through crypto.
No, it's in dollars.
That's right. It's in dollars. And now, because of lawsuits challenging the SEC's reason and rationale, finally a Bitcoin ETF has been approved. Now the general public has, I think the right way to say it is a safe way to
safe and convenient.
A safe and convenient way.
In my Fidelity account,
that's right,
I can just buy it.
To get access to the asset class. And this is another one of those cases where you look over the course of the last 10 years and all of the wrangling and the holdups, and it's hard to figure out why. It's hard to figure out what was the good reason. And oh, by the way,
I have opinions about that.
Hold on. And by the way, when this whole thing started, Bitcoin was sub $5,000. When the general public could have gotten access to it, it was, worth 10% of what it's worth now, right? And so now we're in a situation where finally they can get access to it, but we've already had several halvenings. It's $50,000 a coin now. It's just, it's still
better late than never.
Late than never, but pretty doggone late.
Yeah,
pretty late. And how do you justify this?
Well, I want to try to say this simple point first, which is this was so egregious that the SEC couldn't stand behind the Chevron doctrine. It wasn't unclear. They weren't given sort of the benefit of the doubt, because there was no doubt that it should, especially Bitcoin, which is the one they've allowed.
Right.
It's been defined by the SEC as a commodity. Gary Gensler himself has said it's a commodity. It's a commodity. It should be allowed. There's no question about Bitcoin. I think that's true about probably, I don't know, 50 of the crypto coins.
At this point.
There are examples where it is a gimmicky Ponzi scam thing.
Plenty of them.
But those are not the top 50 market cap ones.
They're certainly not the top 5.
Top 5. Certainly not Bitcoin.
Yeah.
And it was 10 years, and as you say, a 10x lost return for people that have 401ks at Fidelity that they want to buy this.
And probably asset to asset, probably the best performing asset of the last 10 years.
No question.
So like that's the part, right? It's like you didn't let the general public have access to the best performing asset of the last 10 years.
Yeah, but they never do that. I mean, they also don't allow the
Venture.
general public to do venture.
Yeah, I mean, I get that, but this is all just in the
or hedge funds.
Well, by the way, and that's also SEC. So
yes, right.
All of this just kind of goes back to the Chevron doctrine, right? Which is agencies and their authority. I think on the venture side, there was more sort of I don't know. There's more history and more sort of established understanding about the difference between the public and the private markets, and at least you had access to some form of equity, right? It was just it had to be on the public markets, but you had access to some form of equity. But in this case, the general public had no access to cryptocurrency, right? No real access that was, above board, where you didn't have to worry about the exchange that you bought it on being audited, kicked out, FTXing, doing all sorts of crazy stuff. We have legitimate organizations, like you said, BlackRock. I mean, these are all legitimate organizations that are doing these ETFs.
Yeah. There's no question it's the right thing. I mean, you and I are Bitcoin holders now, so it's good for us, but it's good for our parents. It's good for our kids. Like totally. I was talking to my son about it yesterday. He didn't want to do the KYC thing. He didn't want to get, it's a hassle to do. And now he can buy it in his existing
Robinhood account. Yeah, whatever.
Right, exactly. And I don't know. I mean, I think that there was an intentional delay to sort of let Wall Street get their kind of act together so that you could have Fidelity and BlackRock and all the kind of traditional big Wall Street players get involved. Where if you had done it even 5 years ago, it would have been all new players, which would have been healthy for the ecosystem. But, we still live in America with lots of lobbying and lots of ways to at least delay stuff. And so a lot of the Bitcoin trading profits will not go to Coinbase or Kraken. That's or right. the people that really kind of did the hard work to get this asset class to exist. But it still will be better for the general public.
That's right.
And they don't have to allocate, but it's an option for them now.
Yeah. And also, like, Bitcoin kind of anchors everything else in the same way that, Google anchors all the private market tech companies, right? You know what I mean?
Yeah.
We look at private market tech companies and we say there's a chance they could become Google, right? So we look at Solana and we say there's a chance it could become Bitcoin, right?
Yeah.
And so from that perspective, I think Coinbase still has a really good business opportunity there, being the place where you can, pretty easily get access to all the other coins that the ETFs are not going to have access to.
But if the SEC had allowed an ETF 5 years ago,
right,
Coinbase would be running it. And
totally agree.
They sort of delayed enough where all the other people had time to catch up,
get their act together. Yeah,
and I'm not a shareholder of Coinbase, but I think that was not ideal. It was ideal for Wall Street, but at the end of the day, it is now possible to buy it. The foundations can buy it, the institutional investors can buy it, little grandmother on Main Street can buy it, and they don't have to, but they have that option now, which is a good thing.
Yeah. So all three of these stories, we got a story about CMS, we got a story about the FDA, and a story about the SEC, right?
Yeah, they're all being challenged, and the SEC lost. That's before Chevron's overturned.
Correct. Yeah. So we are headed into a world. We just sort of. I think that this the reason why we're talking about it now is, we're now living in a world where we see the impact of, the SCOTUS decision on affirmative action, right? These decisions that are all sort of on deck for this particular configuration of the Supreme Court. They're changing the world that we have sort of all just assumed was the world forever for decades, right? Yeah. They're overturning these fundamental, rules of the way that the country operates, of the way that the government operates. And they're going to have massive, massive changes to them. We just sort of assume that the FDA has this broad remit of power. But if the Chevron doctrine thing gets overturned, there could be some real changes in the way that the FDA operates.
Well, you said it. If they overturn Chevron, that won't fix Congress.
No.
And so they're basically like ripping up the playbook, but there's no new playbook.
Right.
And so we're just going to have chaos.
Yeah,
and in healthcare, because 50% of the market is somehow paid for or regulated, or it's all regulated by the government, so government influenced, I think it's going to have a huge effect on our industry.
All right. Good show, man.
Yeah. Happy to be back. I love the holidays, but I'm also happy to be back and working and getting going.
Likewise. Next week, we have Emily coming on. We're going to have Emily coming on once a quarter to just kind of give us a rundown on all things policy that are going on. And then shortly after that, we'll start looping in guests on a week-to-week basis, which we're super excited about. We got Nzinga Harrison, who just released her book, Congratulations on Addiction. And I got to actually read it, but it's at my house. We got Dr. Jay Bott from Deloitte coming up. Ambar Bhattacharya from Maverick Ventures. Yeah. So great list of guests that are going to be coming up in the coming weeks. And that means we'll be releasing not just one episode, but 2 episodes a week in these weeks, because we're still going to do our weekly roll-up. So exciting things ahead for the podcast. And we've also got some other tricks up our sleeve. So, definitely let your friends know, subscribe, share, give us a great review on Apple Podcast or on Spotify.
Yeah, thanks.
All right, bye.